the pity is that because they are mature people, you can't push them. They repeat not because they are not taught, they were not guided. They repeat because they fail to pass because they are not active. And nobody beats them for not being active. Great. So that is IS 19. So that's our IS 19. I want to move on. I'm trying to recall my timetable. I had other standards to deal with after IS 19. And those are the ones that I want to look for. See what else. Maybe let's see the question that we've been doing could guide me to see what is part B here. Oh, part B is Ifrs 15, construction contract. The moment I say that word, that contract with a customer, you say, there are students who don't pick this quickly, that if I see that headings, contract with a customer, and what have I done for the customer? I've constructed, then I'm going to earn revenue. So that's Ifrs 15, revenue from contracts with customers. Okay, so let me just again do a little summary of that. I'm not going to teach it. I'm summarizing it. I'm summarizing it. Ifrs 15, revenue from contracts with customers. So Ifrs 15 is titled revenue from contracts with customers. Okay, so when you look at this standard, ideally, you're looking at it from the seller's point of view, not the customer. So always remember, don't go in the exam and start making fun. That this standard is also applied by a customer. This standard is applied only by the seller. So it's the seller entity that applies Ifrs 15. Okay, account and recognize revenue from sale of either goods or the sale of services. This should be normal sale of goods. So it's not a one-off sale of goods. So this is ordinary sale. Let me use that word, ordinary. That the reason why this company was established as, say, MTN is to ordinarily sell airtime. So they are selling services. Okay, it's ordinary to sell phones. So they're selling goods, okay, to the customer. Okay, in which case that revenue that I want to recognize is only based on the fact that you've transferred control over that good or service to the customer. So this is only when, only where the entity has transferred control. So the big word here is control. You transferred control over the goods or over the services to the customer. Because you've transferred control over the goods or services to the customer, that's when you recognize revenue. Please, at advanced financial reporting level, don't discuss and conceptualize issues like those junior people, the intermediate level. I1.3. Let's just assume, what if this is a company selling hardware? It's a hardware company. You know, those selling cement, selling iron bars, selling those building materials. What if a customer went and bought 100 bags of cement, but those bags of cement remain with that hardware company? Has that hardware company transferred control? You know, you need to understand what is control. Control is that risk and reward associated with those goods. Control is that fact that I can benefit from using that asset. So if those 100 bags are still with the hardware company, in an arrangement, part of the contract, that you remain with them. I have given you, I've paid for 100 bags, but I'll keep coming to pick 10 bags every day or every end of the week. So keep the 100 bags, and I've come and paid the 100 bags. Should this company say that today I'm recognizing revenue for sale of the 100 bags of cement? Has the company transferred control over those bags, the customer yet? In reality, that is like deferred income. It's not yet revenue. You've not yet earned it until those have gone. It's different Please, at advanced financial reporting level, you need to be very good and smart in analysis. It's different from a case where this customer comes and pays for 100 bags of cement, says, fine, I have paid, and here is my receipt for payment, but let me quickly go and pick a lorry to take my bags of cement. So in that case, the risk has gone with the customer. If he finds this hardware shop has caught fire, it's you who failed to take your bags of cement. We delivered, we gave them to you, we passed over contract to you. We even took them away from the stores where they are kept. We put them somewhere in the shed in front, waiting for your car. When the car comes, they're going to pick them from the shed in front. So in that case, the company, the hardware company will say, I am recognizing Revennue for those bags of cement because they're out there. Even where they're out, there's a very big word or signage saying that they are here arrested at your own risk. The things you find in parking lots, that you're parking at your own risk. So that risk is now with the customer. So the control was transferred. So be analytical in this paper. You may need to they can create those scenarios. So what you need to pick here is that only when the enter has transferred control over the goods to the customer. Now, for you to recognize that revenue, remember, there will be 5 steps. So apply 5 steps to recognize that revenue. So there are 5 steps that are applied to recognize the revenue. So mean that you don't just jump and say that I'm now recognizing revenue without going through specifically or in the order these 5 steps. 1 is that there must be a contract between you and your customer. So a contract exists. So a contract exists between you and the customer, between the entity and the customer. So if you want to certain books, they will say a contract with the customer exists. So that contract will usually have terms and conditions. So those contractual terms and conditions. And clearly, both the customer and the entity must have understood and accepted those terms and conditions. Okay? So there must be first a contract. Please, that contract does not have to be written. It could even be verbal or implied. If you went to a supermarket and you're actually going along the shelves and you want to pick sugar, it does not have to require you to go to the supermarket management and write a contract that I want to buy a kilo of sugar. No, it's implied that when I pick that kilo of sugar from the shelf and go to that lady who I paid to, then the contract has existed. That I have picked 1 kilo, it's exactly 1 kilo, I have paid for it, the price for that kilo. So the contract can be implied, it can be oral, it can be verbal. Though in some cases it will be written. Secondly, separate performance obligations have been identified. Separate performance. Please, these performance obligations are for the company. So separate performance obligations to be carried out, to be satisfied by the company have been identified. So the seller is the one that has performance obligations. Don't say that are those performance obligations for the buyer. No, they're not for the customer. But we need to have them identified. If possible, they should be separable as much as possible. So can you distinguish them? That's the word they will use. They are distinguishable. Separate and distinguishable. I'm trying to see how I can explain that word from English in English for you to appreciate and understand it. Distinguishable. So in other words, you can separate it. They can stand on their own. Distinguishable. Okay, so I can separate and have them distinguished. Let me give you an example. It's very possible that Icpar is the entity and you're the student, you're their customer, you're their clients. Truly, it's as a result of the engagement with you that they recognize their revenue. For them, they're giving you services. There are cases where they could be giving you books as well, but let me assume that we're looking at services. So we are going to separate the service of giving you access to the exam the moment you pay for that exam. or the moment you register as a student. So if we can separate that service platform from which you can access the exam, from the service platform from which you can access the past papers, from the service platform from which they can give you online materials, then those are distinguishable. We can distinguish this performance obligation from the other. If you're paying them one total amount of, say, 100,000 francs, then they are separating the performance obligations for each of them. Later, you'll see me doing that in step 4 or in stage 4. Okay. Step 3 is that I should be able to determine the transaction price. I should be able to determine the transaction price. So I should be able to determine that transaction price. That's the easiest for any student. The only thing about that transaction price is that in terms of the separation of these separate performance obligations, you may need to align it to what we call standalone selling prices. Mean that here you need to take into account. For example, the standalone prices where needed. Okay. You may also need to take into account what we call variable prices. Variable versus fixed prices. So in that transaction price, there could be an element of a fixed sort of variable price. Let me give an example. They could tell you that I'm selling you 100 kilos of rice at this price. But if you buy this extra item or this extra quantity, then instead of charging you 2,000 francs per kilo, the price will vary in others with the quantity. So I'll instead charge you 1,800. So there's a variable element. It varies with the kilos you buy. The bigger quantity, they'll give you a discount. At times people call it a discount because they call it trade discount because you've bought a big amount of items. So that variable aspect is usually based on conditions. Okay. The variable element, so I put here where variable element in a price, transaction price, variable element, a transaction price is driven by conditions, the certainty of those conditions being satisfied. Transaction price is driven by the certainty of specified conditions being satisfied. Specified conditions, circumstances being satisfied. Like I've talked about the quantity you buy of the rice. If you buy that so many kilos of rice, they will give you a discount. So that discount is the variable. It varies. It can be 2,000 per kilo if you buy less than 1,000 kilos. It can be 1,800 francs per kilo if you buy more than 1,000 kilos. So it varies. So that variable element can be in the transaction price. People may want to call it discount. Okay, so step 3 is to determine the transaction price. Step 4 is to allocate that transaction price to the separate performance obligations using the standalone selling price approach. So allocate transaction price. Remember, you've picked this transaction price from step 3 above, okay, to the separate performance obligations. Remember that separate performance obligations are in step 2 above. But that allocation is using what we call the standalone selling price approach. Using the standalone selling price. At times we call it pro rata then. Okay, so that's step 4. Step 4 may be one of those hardest to students because there's got to be some bit of calculations as you do these allocations. It's even very possible you are allocating a wrong transaction price because you're putting in a variability when the conditions specific to that variable were not highly certain or satisfied. So that step 4 can become a problem then. Otherwise, then step 5 is now to go ahead to recognize revenue. Remember, for you to recognize revenue, you are crediting the revenue account, sales revenue account in the P&L. You're crediting the sales revenue account in the P&L. And this is only when, where the performance obligations or as and when the performance obligations are being satisfied. Yeah, this could be satisfied either at a point in time, which is the easiest any student would want, or it could be satisfied over time. So either at a point in time, so in that case you recognize the entire revenue there and then, or it could be at a point, so it could be over time. Over time. When you go over time, then you're going to use what we call a percentage of completion, driven either by the cost method or the value method. Okay, so just for me to say that where performance obligations, which is what the examiner usually allows, performance obligations satisfied over time. If performance obligations are satisfied over time, then that step 5, you need to be very careful about it. So here we shall say that then our revenue will based on a stage of completion or a percentage of completion. So we shall have a stage or a percentage of completion at the reporting date. Please, that percentage of completion must be calculated as computed at the reporting date. How do you compute that stage of completion? Either using the cost method, you could use the cost method, or you could use the value method. Using either the cost, at times people call the cost input method. Okay. The cost or input method is to say that my cumulative cost to date, versus or in comparison to the total estimated contract costs times 100%. So we put it in percentage. Or we could have what we call the value. Value at times we call it the output method. Output method. And how do you calculate the output method? We shall get instead the value of work done. So this is like your monetary value. Work completed. Okay. Divide by or in comparison the total contract value, or what they call the total contract price. Okay. The total contract value or total contract price times 100%. So getting it in percentage. That helps you to determine the stage of completion. Okay. So in the event that you have this contract which goes beyond 1 year, then we may also assess what we call the cumulative stage of completion at the end of each subsequent year to determine the change in revenue to recognize in that year. So, yeah, contract spans or overlaps more than an accounting period. Like it's a 2 or 3 year contract, then in this case we shall get the cumulative stage of completion, at each reporting date, yeah, less a prior year stage of completion, to determine the change in the stage of completion, to determine change in the stage of completion that gives us the revenue for that year, which gives the sales revenue. The sales revenue to be recognized in the year. Okay, so mean that you look at cumulative position. You look at the cumulative position, then you now say minus the opening cumulative position of the prior year. The difference is the additional revenue in the year based on this contract where performance obligations are satisfied over time. Okay, so in most cases, therefore, the extracts you're going to have in the financial statements. So your extracts in the financial statements where we have our percentage based on, so our performance obligations based on, which are satisfied over time. Yeah. Yes. Obligations satisfied over time. Our P&L, you may have to do the following. Let me put in a table here to look it more, to make it more orderly. But this is the format, or this is the arrangement, or the style you may have to go to be able to get your figures in there. So this is what I'll do in my P&L. Sorry. My profit or loss, I'll have a line called revenue. For this particular contract, this will be for each contract. So that this is in total. For each contract I have with a customer, I'll have a line called the revenue for that contract. This revenue will now be based on that stage of completion, that percentage of completion. Okay. The examiner will give it to you, or you may compute it by that. It's not a must that the examiner gives you that percentage. You may compute it using the output method or using the input method, depending on what the examiner tells you. Okay. Then you're having the revenue, sorry, the cost of sales. Cost of sales. Because this is a matching figure, usually this is going to be, so this is on the matching figure, it's going to be a balancing figure. This will be a balancing amount. A balancing, yeah. After you have gotten the profit on the contract. So that figure there is usually going to be a figure you are going to work backwards after you've gotten what I'll call the profit attributable to that contract, or the attributable profit. The attributable profit. The contract. This attributable profit profit on the contract, you are going to compute it at a percentage which you've finished, percentage of completion, times the contract profit, contract total profit. Recall that the other was percentage of completion times the total contract price. That gave you the revenue amount. You used your calculator and you got this figure here. Let's assume that this figure was A. Then you have this figure here, which have also computed separately as B. You can work backwards to get the cost of sale, which will become your figure C. So your figure C is likely going to be a figure you're going to get on the calculator as A minus B. That should be able to give you that C. Okay, so in this case, I've left a line in between here because there could be those particular expenses that were not foreseen. We call them the unforeseen expenses, which you should fully recognize without particularly being based on or pegged on a percentage of completion. Okay, so let me just put them here. So, for example, you could have the foreseeable losses, especially on an on-areas contract, a loss-making contract, foreseeable loss on a loss-making contract. Okay, or the unforeseen expenses. So here, basically, these are all 100% going to be recognized. Don't say those are going to be based on percentage of completion, if any. Okay, so those will be 100% recognized. In most cases, the examiner will not combine them anyway, but in case they are there. Okay, so that is what will happen in my P&L. How about in the balance sheet? I want the extract in the balance sheet. So in the statement of financial position, in the statement financial position, again, I'm picking just an extract. Just an extract. So this extract here, which again, I'm going to put a table it so that I look organized. Okay, so here we're going to say that this is usually going to be guided by a format where we shall say that our cumulative cost to date, our cumulative costs that we have incurred to date. Okay, so we shall have that figure there. Okay, we call this figure D. We shall say plus the cumulative attributable profits to date. Profits to date, and these have come from the P&Ls, those accounts, the different years, okay, including this year. This is the figure we have up there as B. That figure we have as B above, in the P&L above. The figure as B in the P&L above. So that figure you had up there, that figure there, if you had more than 1 year, you accumulate it across those years. Okay, so that would be there. This should be able to give us the total. So that total is what I'm now saying D plus B. At times, I don't want to use the word turnover. So in total, this is what we have so far. Perhaps this would look like the total profit so far. Okay. Now we shall compare these with the progressive billings to date. So we shall say, yes, the progressive billings. Those billings are like invoices. Invoices you've given to the customer. Invoices, the customer. To date. So how much, what invoices or how much are the value of the invoices you've given to the customer to date? Okay. So let me call this figure, assuming that this figure here, I had labeled it E, and now I'm labeling this figure F. The difference between E and F is either a contract asset or contract liability. I didn't want to mention those two words, contract asset or contract liability, until I come to this figure or to this table. So the difference between E minus F is either a contract asset. So when is it a contract asset? It's a contract asset when E is bigger than F. It's a contract asset when E is greater than, I'm looking for the greatest sign on my keyboard here. Yeah, I can't see it. I can't see it, and I don't want to write it in full. Okay, let me force to write it in full because I can't see that sign. So I say when E is greater than, E greater than F, you have a contract asset. Or it could be a case of a contract liability. So it's a contract liability when E is less than F. E is less than F. So in the exam, you need to see, is that figure E greater than F, or is that figure E less than F? To say I have a contract asset or I have a contract liability. Please, contract assets are going to go in the current assets, except where the examiner is specific that could take it to non-current assets, while the contract liabilities are also going to go to the current liabilities, except if the examiner says present it in the non-current liability. So I'll just say that the contract asset is going to be presented in the contract in the assets. Is presented in the assets. So I'm in the balance sheet, and there's what we call assets. So those assets could be current assets or non-current assets. The scenario will be able to guide you. Okay. Now, if it's a contract liability, again, I'm presenting this in liabilities. Usually, you can call it deferred income. If you've heard of that word, deferred income, when it comes to maybe getting monies in advance, it will be a case of a contract liability. So you've received the money before you commit or before you satisfy the performance obligations. So you have a contractual obligation or contractual liability to that customer. So when I have presented this in the balance sheet as either a contract asset or contract liability, in addition, I may also present a certain mathematical figure as either a receivable. Usually it's not be a receivable. So I would say that in addition, still in the statement of financial position, I'll look at the total amounts we've progressively billed the customer and the amounts we've received from the customer. So we shall say total progressive cumulative invoices, call them invoices, and we call them billings, customer, the customer to date by the reporting date. Okay. So that figure, let me call it, I call this G. Let me now have a figure H. The student is having all these figures in the scenario. Then you're saying minus or less the cash receipts, the customer. So if you've so far billed the customer 100 million and you've so far received 90, that 90, the difference between 100 and the 90 is the receivable balance. So I call this J. Then the difference is the receivable balance, which goes under current assets. So the difference here is going to be my receivable balance. So this receivable balance is the difference between H minus J. Okay, assuming that I did not that difference as K, this is going to be presented the current assets as your receivable. You know, receivables are put in current assets of the group balance sheet. So of the balance sheet. So I have that figure there. Okay, so ideally, that is the main focus of your paper on Ifrs 15. Of course, the extra things in there could be things like onerous contracts, the loss-making contracts. What do you do with those? So in that here, you also need to read further. It's not very common in the exam. What happens to onerous contracts or loss-making contracts? At times we call them loss-making contracts. We also assess them based on the percentage of completion. No. The entire contractual loss you've estimated must be recognized in full in the profit or loss account. That's the simplest thing. That's the obvious thing about onerous contracts. Okay, so just to recap again, Ifrs 15, as especially the core areas that your paper is looking for from a student. Please, it's the seller. Don't go in the exam and start advising the buyer. Mr. Customer, because the scenario can bring a situation where they say ABC Limited has purchased or bought goods and paid this amount of money. So by virtue of that transaction, it's a buyer. Don't say that in accordance with Ifrs 15, you're wrong. Ifrs 15 is only when the question says ABC Limited has sold goods or services. Sold is the word. So it makes you the seller. And therefore, it's you as a seller who applies Ifrs 15. And only when you've transferred control. If those goods are still in your possession, they are not yet revenue. Match to that is that you cannot even say cost of sales. So you cannot take them out of inventory. So IS2 and Ifrs 15 will combine. Ifrs 15 says, don't say I have revenue. If there's any money you've received in advance of those goods that you've not transferred to the buyer, please, that money seems to be deferred income or it seems to be a loan supported by the goods being security. Therefore, don't even go to IS2 and say that because this inventory has been sold, though it's still with me in the warehouse, then I am recognizing the inventory. out of the asset account called inventory and transferring it to the cost of sales to say that this is the cost of sales. You are wrong, wrong, wrong. That inventory should remain in your balance sheet. It should remain there. Don't transfer it to the P&L to a line called cost of sales. Okay. Otherwise, if I have revenue to recognize, always in my mind is the 5 steps, whereby step 1, I need to determine that contract I have with the customers. Usually it rotates around the terms and conditions. That contract does not have to be written. It can even be implied or verbal. Secondly, I need to identify and separate out the performance obligations. Me, the seller, I have towards this sale transaction. To the extent that I can separate them out, I will be able to allocate transaction prices to them on a standalone selling price approach. Otherwise, I also need to determine the transaction price. It may look easy to a student, but it may be affected by a variability. So if there's information in the scenario to say that that price can be discounted to this amount per kilo or per quantity, if the customer bought this big, then at that point I need to assess and check, is it virtually certain that the customer will buy that quantity, to therefore benefit from this variability or discount? If the scenario says yes, it's highly certain, or the scenario says that it was not certain, then don't go and put in that variability if it's not certain. Don't take into account the variability. Otherwise, then I'll allocate that transaction price after considering the variability. If there's any issues to do with variability, I'll allocate it to the separate performance obligations I had here using a standalone selling price, meaning that I needed that standalone selling price even at that level, because it's going to help me prorate this transaction price to the separate performance obligations, which then I start recognizing as and when I satisfy the performance obligations. I could be lucky if I'm a shopkeeper and some customer comes to buy sugar. At that point in time, when I transfer the kilo of sugar to him or her, then I should recognize revenue immediately. But I may be unlucky that I need over time, over a period of time, to do additional things or to actually satisfy performance obligations. In that case, I should not rush to recognize the entire revenue. Instead, over time, I should keep assessing the percentage of completion, either using the input method or the output method. Whichever method I use, I will actually always get the percentage of completion and take into consideration whether this contractual period is more than 1 year, it overlaps over more than a year. Any year that it overlaps, I need to look at the cumulative position of the stage of completion against the last reported stage of completion, to look at the change in the stage of completion to determine the revenue of that year. When I do that, my P&L will have some story to talk. Just like the statement of financial position will have some story to talk. That story you're talking is what the examiner is marking. If you tick, 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 tick. Some of them are even getting calculation marks. You're getting tick, 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 and you're writing those stories through this format, and that format to the examiner is what is ticking, that this student is telling the story. I hope you understand when I use those terms to make it easier for you, to make it fun and simple. Understand? And the examiner says he or she knows her or his Ifrs 15 well. Let me check if I have those. When I don't see questions, I have 2 positions to assume. 1, they have understood it. Second, or optionally, they are tired. They are not understanding. They need a break. So I'm assuming the second, the latter. You may need a break now. In the break which I'm giving you, and it's not going to be a long break anyway, maybe about 10 minutes, I want you to use the same break to reassess your understanding of these basics. I've summarized it in your textbook. You may have Ifrs 15 maybe on 7-10 pages. I think ours is, I'm trying to see if I can get it. I can get it on 1 page. It was almost fitting on 1 page. Finished. Okay, so 10 minutes break, then we'll come back and deal with same question. I think this was this same question. I saw that there's something to do with construction contract with the customer. Okay, so 10 minutes break, then we'll come back to this. I will still leave, I think it's better for me to leave a summary, especially for those of you who are active as requested, to write down something on in your book. 10 minutes break. Okay. Okay, so let's resume, and I want to resume. Before I get to the question, I want to just check in the chat whether I have any questions that have come up during the break, because we didn't have the questions before the break. Okay, so yes, I see in the chat we have a couple of questions in there. One says, one of the last sitting, February 2026, include asset ceiling. Oh, this is on IS-19, include asset ceiling, and it is confused somehow. People have told you that tomorrow I have a question. Tomorrow I have a double. I have a question we're going to do which has asset ceiling. Please be patient, otherwise we are running away from the timetable. We are going to repeat ourselves tomorrow, and we shall have lost today's agenda. So tomorrow we have a question that has past service cost and a question that has asset ceiling, and we're going to deal with it tomorrow. So I think I've repeated myself 3 times now. Okay. Then somebody says, what's the difference between H and F in that table of financial position? So let's see what was wrote, H and F. What's the difference between H and F? F is here, and then H is here. It's the same. It's the same. So H and F is the same. So maybe I can say H. Let me call it F again so that you don't get confused. F. So that we have 1. Okay, so thank you for that. So H and F is the same. Okay, so let's see if I have another question in the chat. Okay, so the lazy one is starting to ask for the document. Please, I'll give it to Icpar. Icpar is the one, somebody saying after class, those, I think these are the ones who don't write. Can you share with us this revision? Please, that will be done by Icpar. It's part of what they are planning to do. I only requested that don't wait. You never know when they will give it to you. But hopefully they give it to you as soon as possible when it's still hot and you remember. Okay. Another one says, it will be better for us if you share us the sheet after revision. Please, yes, we pray Icpar gives it to you, Icpar, as soon as we are done with the revision, because it's not my duty, it's Icpar, and that's the terms and conditions I have. Okay. Somebody says no voice, please. Oh, is it possible that you're not hearing me? Can anybody in here say yes, you hear me, so that we get to know that is Emmanuel. Emmanuel has a problem with his own network. Emmanuel Nkuruziza says no voice, please help. If anyone can say in here that you can hear me, then it means that maybe the network problem is not mine. Oh yes, people are saying yes, they hear me. So Emmanuel, I don't know what to do. Maybe somebody can write, and in the chat, you can write Emmanuel Nkuruziza, restart your own computer or device. The network problem could be his then. Okay. Okay, fine. Oh, maybe, yeah. Oh, I've understood. I think Emmanuel's problem is he joined while we're in a break. That's why he wasn't hearing. Sorry. Fine. Okay. Okay, so Michael, the question you're asking, I wish there was an Icpar person in here, because me, I'm basically a facilitator or a consultant coming in. So Michael is saying, is it possible to have a link of the recorded videos? Because some of us lost network while serious matters were moving on. I understand and I appreciate. I feel for you, Mike, and there are others who are actually having challenges with the internet. I'll pass this request to Icpar so that it actually passes over these recordings and even the materials, these documents in front of you, which I'm using, as soon as possible, so that you don't lose the mentor, that excitement while you're still having it now. So I'll let them know. Okay, fine. So I think that is it. So can we move over the same question we've been doing, but part B? Okay, so this question is Butera. So I'm moving back to Butera, but part B. And this question, remember, is a question for April 2023, question number 2. Our question. a revision question on ICE 15 is again the April 2023. Okay. Question 2, part B. Okay, and this question is Butera. Okay. So let's go in there and through together. First, the requirement. Let's move to the requirement. For 7 marks, it says prepare extracts of Butera Engineering's financial statements. So it's just extracts. You don't have to prepare the entire financial statements, just extracts. Okay. So the financial statements. Now, in the financial statements you're preparing, they want you to reflect the financial performance and the financial position of this construction contract with the customer. So they want you to present the financial performance and the financial position in respect of this contract the company has with the customer. Okay. Then they're going to say that as at the year end, October 2021. So the year end we are focusing on is the year end, 31st October 2021. But they also want a brief explanation, so don't leave without any narrative. So you need to run an explanation on the impact of the bonus. So the impact of the bonus on the accounting for the contract. Okay. For Butera, or for the contract in Butera's financial statements. So mean that preparing extracts is at figures. So we're going to run figures, but in the process, they also want you to do some narrative, briefly explain the impact of the bonus on the accounting for the contract in the financial statements. So let's go through the scenario. They're telling me that at the start of the year, 1st November 2020, so that's the start of the year, by year end will fall 31st October. Butera Engineering entered into a contract. I hope you remember step 1. Do we have, if we have to recognize revenue, do we have a contract? Can we determine that it's a contract between the company and the customer? Yes, they have entered into a contract, and the contract short terms are that which will make up specific. So it's a specific performance obligation. The obligation is to construct a machine on the customer's premises for a promised transaction price. So that transaction price, they've given it to us. Usually they'll give it to you. All you need to check is whether in there could be standalone selling prices or variable and fixed elements in that price. So the transaction price is 210 million francs from what I have here. So that's the transaction price. Okay. But now in addition, there's also a bonus of 14 million if the machine is completed in 24 months. So you see, they put in a condition that if the machine is completed within 24 months or within 2 years, then it's not only 210 million, but 210 plus 14 million. So that 14 million is variable, it varies. It depends on completion within 2 years, 24 months. If you don't complete within 24 months, you'll not get the 14, you'll only get the 210. So I mean that as I think about the transaction price, is the transaction price 210 plus 14 or 210 alone? I'll only determine the 14 if it's highly certain. Just remember, if we go back there, we say that if I'm talking about a variable consideration within the transaction price, it's only if it's highly certain that that attached condition will be satisfied. So I mean that as I read through, I need to pick out or look out for any high certainty or no certainty whether that 14 million will be earned. If it is highly certain they will earn it because they will complete within 24 months, then we shall say transaction price is 210 plus 14. If it's not certain that they will complete within the 24 months, then the transaction price is only 210. Okay, so let's read further. They told me that at the inception or at the start of the contract, Butera correctly accounts for the promised bundle of goods or services as a single performance obligation. So here we don't have separate performance obligations. It's a single performance obligation. And don't even debate with this company because this is correct. They have correctly assessed and determined that they only have one performance obligation. So If you wanted to think of step 4, that I want to allocate that transaction price to the separate performance obligations, there's only one performance obligation. So we only allocate it to this one performance obligation, and they want us to abide or to comply to Ifrs 15, which is to allocate it to only this one transaction price. Sorry, contract, performance obligation. Now, the second paragraph says that at the start of the contract, Butera expects the cost to be 112 million. Perhaps I forgot to tell you that right from the start and continuously, you need to assess whether this contract is a profit-making contract, because it's only profit-making contracts that you're going to assess stages of completion or percentage of completion. If there are loss-making contracts, which are onerous contracts, we don't go by percentage of completion. You recognize the entire loss or the full loss immediately. Okay, so if I start again, at the start of the contract, Butera expects the costs of the contract to be 112, yet the contract price is 210, or it could even be 210 million plus 14, implying it's going to be a profit-making contract. So everyone is a profit-making contract, and the performance obligations over time, then we shall assess stage of completion at each reporting date. If it's a loss-making contract, we call it an onerous contract. Don't start assessing stage of completion, because the entire 100% loss should be presented and recognized. Remember, if it's a profit-making contract, because the transaction price of 210 million is bigger than the total estimated cost of 112, and the performance is going to be over time, the performance obligations, in that case, don't take the entire profit to the P&L. Instead, assess the stage or percentage of completion. It's that percentage of completion that shall give us the percentage or the amount of the attributable profit on this contract. So at this point, I see it's a profit-making contract, because if the cost is 112 and the minimum transaction price is 210, it will even increase to 210 plus 14. Then at this point, it's a profit-making contract. Now, they tell me that, and they conclude that it's highly probable that a significant reversal, you see how the examiner is playing around this, in the amount of the cumulative revenue. You know, the students are not understanding what is the word, what's cumulative revenue for. So it's highly probable that a significant reversal in the cumulative revenue, and you're wondering cumulative revenue means what? That additional 14, they are not accumulated to the 210, will occur. So a student is here confused, and because he's in a rush, he's in a hurry in the exam, he says, oh, that statement now means, if he goes back, that statement means that that 14 million, which is variable, it is highly certain that the condition will be satisfied to complete the work in 24 months. So that student now says 210 plus 14. That student is wrong, because the examiner just changed this word, the word reversal. It's highly certain that they will reverse getting the 14 million. That word is the one that completely disorganizes students in this setting. That a significant reversal. If they had not put that word reversal, it was going to be 210 plus 14. So here it's implied that they will not get the 14. The customer will not give them the 14. He will reverse it, because they will not complete within 24 months. And that's highly certain right from the word go, from the inception of the contract. So back to the scenario. Completion of the crane is highly suspectable, or is highly going to be affected by factors outside the company's influence or control, as this is due to mainly the supply of components used in the construction of the machine. Maybe the supply of these components is coming from outside the country, and there are going to be factors like the flights, like the clearance and the customs. Those may impact on these components coming to the company, and the company using those to do the work and complete in 24 months. So all this information is to tell you that more likely they will not earn that extra 14 million, because they will not finish within 24 months, because even the supplies that are used in the work may come in late. So this statement here, or this paragraph, is coming back to tell me that that variable amount of 14 may not qualify. So our transaction price may only remain with 210 then. Okay, the last paragraph says that therefore during the year, Butera incurred costs on this contract amounting to 65 million. So these are the cumulative costs incurred to date. Remember, I will use this when I'm dealing with the statement of financial position extract. But the cumulative costs incurred to date are 65 million. And this includes components that will even be used in future when constructing this machine. Okay, which is okay because that's part of the balance sheet closing inventory or unused items there. So they will be used in the following year. So that should not struggle or make you struggle to say, what does that mean? You all know that under balance sheets inventories that are part of either work in progress or finished inventories, or even including components like materials, raw materials, are going to be part of inventories, closing inventory, future use, and we'll put them in the balance sheet. And yet we are going to look for that extract in the balance sheet that is cumulative cost to date, including the unused items, which will be used in the following year. So that's okay. Back to the scenario. The total invoices issued. Now that's what the other gentleman was telling me, the difference between H and F. So these are the progressive invoices that have been issued. The customer are 140 million. So I have that figure now. So these are the billings or invoices issued to the customer by the end of the year. And the customer has partly paid 120 million of the 140. So there's still a balance of 20, which is the balance receivable, which we shall put in the current assets. Okay. Now, on 30, back to the scenario, on 31st October 2021, Butera has satisfied 45%. Now here they've calculated it for you. Okay. Otherwise, they could give you information to calculate it yourself. So the 45% is the stage of completion. They've based it on the cost incurred to date, meaning that it's based on input method or cost method. But they've given it to you. Don't start debating it and recomputing it, except if they told you it was in error. Okay? And they conclude that the variable consideration is still constrained. They cannot earn it. That variable consideration is the 14 million. So indeed, all factors indicate that the transaction price is only going to be 10 million. So I'm going to use that information to do two things. I have a brief explanation of the impact of that bonus, that 14, that variable consideration in the financial statement. Then I also have extracts, which will be the figures. So let me go back to my document, which I suppose you also have opened somewhere, somehow. Of course, I appreciate the fact that network can be a problem. I'm lucky that it's not a problem on my side yet, because you all need me. Okay, so I'm starting with a brief explanation on the treatment of the bonus. Brief explanation, treatment, accounting, treatment, the impact. I think it was the impact of the bonus. Okay, of the bonus in the financial statements of the company. Okay, please, this bonus is a variable consideration. I can put it here in the bracket, which in accordance with Ifrs 15 is a variable consideration or a variable element of the transaction price. Okay, so I'm starting with that brief explanation. We could even put it here so that bonus amount given in the scenario is a variable element of transaction price. Okay, as it is conditioned, on the entity or on Butera completing the construction of the machine within 24 months. So you're starting to tell the examiner you're dealing with a variable condition. whereby you say that, therefore, in accordance with IFRS 15, you may have forgotten that number of the standard. You could even say, in accordance with accounting principles, a variable consideration or a variable element related to the transaction price is only included in the transaction price where it's highly certain that the entity will satisfy the specific conditions in the contract that relate to the variable condition. So a consideration. So you say that according IFRS 15, a variable consideration relating to a transaction price okay, will only be included or added to the transaction price. The transaction price if it's highly certain that the entity will comply to or satisfy, let's say comply to the specific conditions in the contract granting the entity that transaction price. Entity and variable consideration. So you're quoting a principle in IFRS 15, and the examiner is ready to earn or give you a tick for that. Okay, then you go on to say that otherwise, in the absence of that, you do not recognize it in the transaction price, but you can disclose it in the notes to the financial statement. So the absence or in the absence, satisfy the conditions, variable consideration not added transaction price but only be disclosed in the notes to the financial statements. It will only be disclosed the notes statements. So given that alternative, in failure of a company to earn it, then we still go and disclose it. Then you say that therefore the variable condition, sorry, the bonus or the variable consideration of Vutera will not be added to the transaction price, as it's not highly probable that it will be earned. Or you use the terminology they've used there. So you say that, the bonus amount of 14 million in the contract. Teller's contract with the customer. Say enable Teller's contract with customer will not added the transaction price as it is highly probable, that a significant reversal, I'm using exactly the words they've used, but even I've said it's not highly probable that Butera will be able to complete the construction of the machine within 24 hours. Okay, a significant reversal is likely to occur. And therefore 14 million cannot be added to the transaction price, but its details can be disclosed in the notes to the financial statements. Yes, the 14 million cannot be added transaction price of 210 million. Price of 210 million. Okay. 210 million, and therefore Butera will only disclose this bonus amount in the notes to the financial statements. In the notes, financial statements. Okay, you earn yourself a tick. So you explain the impact there in that case. Okay. Okay, so there you are. Now you come in to bring in your figures to say that the extracts of the financial statements, the extracts of Butera's financial statements, okay, which basically include this transaction. The customer as below. Okay, so I'm going to pick these as I had them here. So starting with the P&L. So what I'll do is just to put in the appropriate figures. So let's start with the P&L. P&L, the year ended 31st October 2021. Okay, so I have the revenue. Remember that they've already told me the percentage of completion is 45%. So I'll say 45% of, so 45% is the percentage of completion. And they gave me the total contract price. So my total contract price is 210 million. I am not increasing it by the 14 million. So it's 210 million. So I'll go to my calculator and say 45% of the 210 million. I have 94.5. 94.5. So I'll come and say I have a 94.5 million here. Okay. These figures are in millions. Okay. Then my cost of sales or my contract costs, basically. So cost of sales is the contract costs you're using to match your sales revenue. I'll come back to deal with it as a balancing figure. I have 0.4. I can even take it out the foreseeable because the whole contract is all profit making. So the attributable profit is going to be based on the percentage of completion, 45%, times the total contract profit. Our total contract profit is the difference between the 210 million is the total contract revenue minus 112, I think, million. Let's go back and check what was the information or figure given to us as the total cost they expect. Here, 112, it's there. That they expect the total cost to be 112 million, yet the revenue is 210. So that should give me the total profit they expect on the entire contract as 210 minus 112. So it's 98, of which 45% has been earned. 45% has been earned, which is 44.1 on my calculator. So 44.1 million has been earned. So I'll go back to my contract cost or cost of sales as a matching figure, picking it as a balance. I'll get my A, which is 94.5. million minus the B, which is 44.1 million. My calculator, 94.5 minus 44.1, I have a 50.4 million. So I have a 54 million. Okay, so there you are. So I'm done with the extract that goes to the P&L for there in the 31st October 2021. Okay, so let me go to the extract that goes to the statement of financial position. So I'm just moving now to the statement of, I can actually put it up here. See, oh, no, I need to copy it from up there. So I'll say that in the statement financial position as at 31st October 2021. Okay, so let me pick the table I had up there and come and use it. I'm doing exactly your open book, I think. That's what you people want to do there. So you can't use the computer skill. So there you have to write yourself, okay? Okay, so in the statement of financial position, as at 31st October 2021, the cumulative cost to date, remember they gave them to us. If I remember in the scenario, let's go and pick those cumulative costs to date, which is that third and last paragraph. That during the year, Butera incurred costs of the contract amount to 65 million. So those are the cumulative costs to date, which is the figure I'm picking. Okay, so 65 million. So let me go back in there. Oh yeah, it's open. So 65 million. Put it here. Okay, so that's my D in there. Then plus the cumulative attributable profits to date, which I'm picking from the P&L above there. You remember that was figure B. At figure B, I put it in here to say 44.1 million. Okay. Then we're going to get the total, which is in this case the 65 million plus the 44.1. That's the 44.1 million. So let me pick it from my calculator. 65 plus the 44.1. I have 109.1. So 109.1 becomes my E. 109.1. Okay. Then total progressive billings or invoices that have been issued to the customer to date. They gave us that information in that last paragraph, that the billings or the invoices they've sent to the customer is 140 million, that figure there so far, 140 million. So we shall come and place it in here to say that that is our F, 40 million. Okay, so therefore the difference between E and F in this case, 109.1 minus, so 109.1 million minus F, which is 140 million. If E is greater than F, then we have a contract asset. If E is less than F, which is the case, we have a contract liability. So we have a contract liability here. Because E, the 109, is less than F, which is 140. So we have a contract liability that we shall present in the liabilities. Okay? So mathematically, on my calculator, I have the difference between 140 minus 109.1. I have something like 30.9. So 30.9 is the contract liability. 30.9. Where do you present that 30.9? Within liabilities. Okay. Now, then in addition, this is what I also go ahead to present. The total progressive billings or invoices to date, which was our F, that 140. I'll pick it and put it here again. 140 million less the cash receipts from the customer to date. We are given that information. If you go back, we're told that the customer in the last paragraph, the customer has so far settled 120 million. So I settled 120 million. So I'll come in here and say minus the 120 million. So of the total invoices amounting to 140 million, if the customer has settled 120, it means that my 140 million minus the 120 million, I am getting a receivable balance of 20 million. That receivable balance of 20 million, I'll take it to the current assets. I'll take that to the current assets. So this student, this is what the examiner did. Having given one mark for up there, the student was now able to start earning half marks along the way. Okay? For example, the student has sweated to calculate this. You remember he gave you the 210, he gave you the 45%, you've used your calculator to get that figure to 94.5. The examiner will say that calculation will earn you a calculation mark of 0.5 marks. Usually, the standard in this paper is that calculation marks are 0.5. If you've calculated it correctly, using the information in the scenario. So you have 0.5 in the process mark there. Then that student has also calculated this running balance, this balancing figure. You remember that balancing figure, you've used your calculator to get these two figures together. So the examiner again will give you a calculation mark here. Let me label this in red so that it does not confuse you there. So they'll give you a calculation mark here for that 50.4. Now also the 45% on the 100, on the figure you had here, will get you a calculation mark. It's possible you may get one full mark because first you calculated 210 minus 112. Secondly, you calculated 45% on that calculation. So it's very possible that here you may, in the worst case scenario, they may even give you one full mark to ensure you pass. So here they'll say times 2. So that will be 1 mark there. Okay. Then you come to the statement of financial position. They will not give you this mark here. This one is a copy and paste. They gave it to you in the exam, in the scenario, 65. So that one, don't expect the person marking you to give you a mark for that. Similarly, they will not give you another mark because they've already given it up here. That 44.1, they will not again mark it. They already marked it. Okay? But now this is where you're going to get a calculation mark. You've used your calculator to get 65 plus a 44.1. They are going to reward you with a calculation mark there. Okay? Now, the 140, these progressive billings, they gave it to you in the scenario. They will not give you a tick and a mark there. That one they gave it to you. But the difference between the 109 and the 140, they are going to give you a calculation mark there. So that 30.9, they'll give you a calculation mark for that. Because that one, you've sorted to get it. Okay? Now, they'll go to the addition, the receivable balance. The 140, they will not give you a mark because they gave it to you. Just like the 120, they will not give you a mark, they gave it to you. But the 20 now, that's your own effort, they will give you a calculation mark. So meaning that if you look at the marks in total allocated to this question, 7, always there should be a provision for those 7 marks in your answer. If there's even more than 7 marks, they will cap it, they will max it to 7 marks. So look at what we saw in the narrative. In the narrative, you picked 4 out of the 7. You've already picked 4 there. You're left with 3. So the 3, you have a 1 there, so a half are there, and another half. Those are 5 now, 5 total marks. There's the 6 mark here. You're left with 1 mark to go. Here it is. The 1 mark to go is there. But in the event of anything where you could have missed something, there's an extra half mark. In total, they will not exceed 7 marks. And this student is done with this part of the question. Somebody says the transaction price is 240. Let's go and see. The transaction price given to us in the scenario was 240. Here I have 210. As somebody downloaded a different paper, me I have 210, not 240. So the one who has 240, I don't know whether your paper is different from mine, the one I downloaded.
There is somewhere you have put 240 instead of 210.
Instead of 210, okay. So let's see, maybe that's why I have an error. 210, or maybe in the narrative here. Oh yeah, sorry, 210, sorry. Okay, so there you are. So that question is on Ifrs 15. A student who has this summary, of 1 page. Yeah, you're entering that exam with a book, I want to assume. That textbook has about 7 pages on revenue. 7 pages are good for you to read them, but after time or over time, summarize them. Summarize them the way I've summarized them, to say, these are the core things I've read in that standard. So it's better you go in that exam with a summarized 1 page. When you open the questions on Ifrs 15, open that summarized page you have of 1 page. Rather than reading all the 7 pages, at times I feel for you. But to get that 1 page, there's some hard work to do.
Hello, lecturer.
Yes?
Hello.
Yes, go ahead.
In the case for this explanation, at the time you only specify that this amount will be will not be considered as a price consideration, and then we use this explanation in those 5 steps will not be marked.
Okay, so here you are not necessarily going for the 5 steps. Why? Because part 2 is asking you to now prepare extracts. Well, step 5, that's the amount you're recognizing. Let me repeat. If you start answering and saying that step 1, I'm going to do this. Step 2, I'm going to do this. Step 3, I'm going to do this. Step 4, I'm going to do this. All those are not necessary, because the question is telling you that, can you prepare a P&L extract where you're recognizing revenue? So as if the examiner is saying start on step 5. But start on step 5, because this work is going to be over time, 24 months and above, over time. Then can you use a percentage of completion? He has given it to you based on this. He has calculated it for you. So I do not agree with a person who's going to start approaching his answer by writing all these steps. When the question is saying, can you give me the P&L extract, which has the recognized revenue? So focus on step 5 there. I don't know whether I'm answering the question of that gentleman.
Yes, yes.
So in the question, when you read the question, you start saying that, is this man starting to ask me to write these stories? Yet he's telling me that prepare the extract. But the only thing that he's asking you in the 3 steps is that there's a step 3 where there's a variable. Briefly explain that one. After you've explained that one, go directly to step 5 and do the P&L extract of that revenue, where performance obligations are satisfied over time. So the only thing on the steps was step 3, the variable element, how to explain it based on the information in the scenario for Butera's financial statements, the impact on Butera's financial statements. That's all. Okay. So we have run out of time. We've missed, what have we missed here?
If it is possible, hello. If it is possible, can you give some notes on the point that I've discussed?
On the what?
Before.
I didn't hear that question.
If it is possible, you can.
I lose your voice. I don't know whether it's only me. You start well, then I don't hear the last words. Maybe you can write it in the chat so that.
I say that if it is possible, you can only give me a short note on the point 7 on the discussion that I've discussed before.
On point 7.
Yeah.
Looking for point 7.
Yeah, for the first discussion.
Oh, the first question.
Yeah.
The first question was ICE 19. Is that what you're asking? Is your question about what we did before Ifrs 15? Okay, I've not understood this question. Let me just check whether he has written it in the chat. Okay, gentlemen and ladies, I'm going to share this document with Icpar, especially at the end of Sunday. You recall that we are doing today, tomorrow we have a double in the morning from 8 a.m. That double is taking us up to 5 p.m. At that point, we shall have written enough so that I send one document when I've finished tomorrow. No, I think Sunday. Because Sunday, I think the Sunday class is also starting early at 8 a.m. So that I send one document, but I'm going to send it to Icpar because it's Icpar that has your email addresses. Great. And it's a requirement that I share this with Icpar because it's Icpar that has to interface with the student. I'll do that on Sunday. I may do it tomorrow if there's pressure for you to find it earlier, but I know even if you received it on Friday tomorrow at 5 p.m., you'll not use it until, because the Sunday class will be early morning, that's what I'm told, from 8 a.m. So more likely then, it's better for me to send it to you after the Sunday class, where we'll have joined all the 4 sessions in this one document. But I'll be sending it to Icpar, not to you directly, you guys. If you allow me, it's a protocol from Icpar. That's the requirement I have to follow. Okay, so this is my...
Excuse me, sir.
Yes.
Is it tomorrow's class will start from 8 a.m. up to 5 p.m.?
Yes, let me write it here. And there's, because it's going to be our session 2, let me write it here so that everybody sees it on the screen. Okay, so session 2. So I'm starting there, session 2, but I'll write from there tomorrow. So it's going to be tomorrow, Saturday. Saturday tomorrow will be 2nd May 2026. So that session 2 is going to start from 8 a.m. Okay, it's 4 hours, 9, 10, 11, 12, 2 midday. Okay, then we shall have session 3 still tomorrow. Session 3 will start from 1 p.m. after a lunch break, I think. So session 3 will be still tomorrow, but it's going to start from 1 p.m. 1 p.m. up to 5 p.m. Okay, so this is my program tomorrow. Tomorrow, I'm trying to think whether, because I wanted to do the earnings per share calculation, I may do it at the start so that that part is dealt with. Now, again, tomorrow, I want to pick on a consolidation question. A consolidation question. Question 1, a section A question. Then I'll come back, especially in the afternoon. I may see, maybe afternoon could be the section A. So that's section B. We'll continue with section B in the morning, you know, when in the afternoon, you bring a section A question. I think so, maybe that's a better arrangement. So in my section B, I'm also going to look at leases, Ifrs 16. Leases, Ifrs 16. I cannot run away from it. We all need it, I hope, or I wish, okay? So I may look at it, Ifrs 16. I may also look at deferred tax under IS 12 and also share-based payments, Ifrs 2. So mean that more likely tomorrow morning, I'm going to start on I-33, that question, earnings per share. Then I immediately go to Ifrs 16, which is leases. Then I go to IAS 12 and pick deferred tax, and then Ifrs 2, share-based payments. Then later in the afternoon after lunch, we bring a section A question, which is group accounts. Okay, somebody is giving us information alert that Olivier from Icpar has told us that the session that was scheduled for 1 p.m. to 5 p.m. has been rescheduled. Okay, fine. Tomorrow in the morning session, we shall get the update. So we are very sure that we have session 2 tomorrow at this time. By then, we shall have gotten the communication that confirms. I'll check with Olivier myself after this session to confirm so that I announce in the morning session. Okay, so please